Usually when you look at a set of facts, there's this expectation of a single objective truth just kind of waiting to be uncovered.
Right.
It's like putting together a jigsaw puzzle. You find the edge pieces, you match the colors, and eventually the picture it reveals itself. You just have to be patient.
Yeah, and I mean, that implies that if you just look hard enough, the ambiguity disappears.
Yeah.
Like the pieces only fit together one way.
Exactly. But imagine you are sitting in a jury box and the prosecution presents a timeline, forensic evidence, a compelling motive,
Sure.
and it makes perfect sense. But then the defense stands up and they use the exact same timeline, the exact same forensic evidence to tell a completely different but equally plausible story.
Yeah, that happens.
And suddenly the puzzle pieces fit together to make two entirely different pictures.
Right.
And you were sitting there realizing that just having the facts, it doesn't automatically give you the answer.
No, it doesn't. And that is the absolute definition of what intelligence analysts call indeterminacy.
Indeterminacy, right.
Yeah. It is a classic, really high-stakes problem in the intelligence community. You aren't lacking information. You are lacking a definitive way to interpret it.
And that is exactly where we are starting this deep dive today. Because you and I are going to step into the shoes of an intelligence analyst alongside you, our listener.
Yeah, we're digging into something really fascinating today.
We are looking at a highly restricted, incredibly dense internal document. It's called the Lamina Intelligence Briefing Cycle 03.
Right. Published on May 24th, 2026.
Yes. And our mission today is to act as analysts, kind of deciphering a potential massive multi-billion-dollar power shift that's happening right now in the architecture of African development finance.
And, the format of what we're looking at is really distinct. I mean, this isn't a standard news article.
No, definitely not.
Or even a think tank white paper that's meant for public consumption.
Yeah.
It is a master briefing.
Which means it's dense.
Very dense. It's capped at an absolute maximum of 15 pages to force precision.
Yeah, stripping out all the noise.
Exactly. It analyzes 24 very specific signals gathered in this tiny window between May 12th and May 22nd. And it pulls really heavily from two major events that happen to overlap.
The Africa Forward Summit in Nairobi.
Yeah. And the Africa CEO Forum in Kigali.
Right. And the briefing focuses on this very specific area it calls Convergence Zone Beta Prime.
Which sounds like a location in a sci-fi movie.
It totally does, but it really just means we are looking at a fundamental pivot in how money is mobilized across the African continent.
Exactly.
So you are going to learn not just what is happening in global finance, but how intelligence analysts weigh conflicting evidence without jumping to conclusions.
Because we have this set of facts about global capital flows and two completely different, equally strong ways to read them.
Right.
It's a financial whodunit, basically, where the answer could redefine who actually holds the power in African development finance.
Okay, let's unpack this inciting incident. The core observation, what they call the distinctive content of Cycle 03, is the sudden, massive presence of the Africa Finance Corporation, or the AFC.
Yeah, the AFC is everywhere in this cycle.
The briefing points out that the AFC is doing two categorically different things at the exact same time within this single 2-week cycle window.
Which is really unusual.
Super unusual. One move is happening in the world of venture capital, and the other is happening in the capital markets. Let's start with the venture capital side. Walk us through what the AFC is actually doing here.
So, the AFC committed $100 million.
Wow.
Yeah, with $40 million already deployed to tech venture capital funds.
Yeah.
The specific targets are the Light Rock Africa Fund 2 and the Future Africa Fund 3.
Okay.
And they're making this move on the LPGP side.
Right. So for anyone listening who doesn't live in the venture capital weeds, let's break down what an LP and a GP actually are. Because understanding that relationship it's crucial to understanding why this move is a big deal.
Absolutely. So a GP, or general partner, is the entity that actually manages the venture capital fund.
The ones making the decisions.
Right. They are doing the heavy lifting, sourcing the startups, making the investment decisions, sitting on company boards, and, trying to steer those startups to success.
And the LP.
The LP, or limited partner, is the entity providing the actual money. LPs are usually massive institutional investors.
Like pension funds.
Exactly. Pension funds, university endowments, family offices, they hand their capital over to the GP and basically say, go make us a return.
So by the AFC stepping in and acting as an LP, committing this $100 million, they aren't just trying to make a quick buck on a tech startup.
No, not at all.
The briefing uses a very specific term for this money. It calls it catalytic capital.
Yes. The stated goal here is to use their initial $100 million to mobilize an additional $300 to $500 million from U.S. and European foundations, endowments, and pension funds.
Wait, so they're using their own money as bait?
Sort of. Catalytic capital works like an icebreaker ship. You know, a massive Western pension fund might look at the African tech sector and think, the water's too cold, or it's too unfamiliar, or too risky.
Sure.
But when the AFC, an institution that intimately knows the terrain, puts down $100 million of its own money, it completely changes the psychology.
Oh, I see.
Yeah, it signals to those cautious Western LPs that the environment is safe to enter.
They are essentially setting the table, laying out the fine china, and telling Western capital to pull up a chair.
That's a great way to put it.
But that is only the first move. The second move happens on the capital markets side. In the exact same 2-week window, the AFC acts as a financial advisor on a massive bond issuance for Ecobank.
Yeah, and this involves a $450 million Tier 2 nature bond.
Okay, there is a lot of dense financial terminology there.
There really is. The statistics surrounding this specific instrument are extraordinary, though. It is the first commercial bank-issued, ICMA-aligned nature bond globally.
Let's take those pieces apart. Start with the nature bond aspect and specifically what ICMA-aligned means in this context.
So a nature bond is a debt instrument where the issuer, in this case Ecobank, promises to use the raised funds exclusively for projects that protect biodiversity, restore ecosystems, or, promote sustainable agriculture.
But I'd imagine investors are pretty skeptical about that kind of thing.
Oh, absolutely. The financial markets are incredibly wary of greenwashing.
Right, companies claiming to be eco-friendly just to attract investment.
Exactly. So ICMA stands for the International Capital Market Association. They set the gold standard, the strict global rules for what actually qualifies as a green or nature-based investment.
Okay.
By being ICMA aligned, Ecobank is proving to the world that this isn't a marketing gimmick. The money is rigorously tracked and verified to be going toward legitimate environmental projects.
Which explains why the rating on this bond was so high, because the briefing notes it scored a Moody's SQS1 rating.
Right, and Moody's is one of the big 3 credit rating agencies. An SQS1 score is their highest possible sustainability quality rating.
Wow.
Yeah, it is completely unprecedented for a Pan-African commercial bank to achieve this level of verified sustainability signaling.
But the mechanics of the bond itself are where the risk profile gets really interesting. Because it's a Tier 2 bond, how does that change the equation for an investor?
Well, Tier 2 means it is subordinated debt. So if Ecobank were to theoretically go bankrupt, the holders of Tier 2 bonds are further back in the line to get their money compared to senior bondholders.
So it's inherently riskier.
Much riskier. Investors usually demand a much higher interest rate to take on that kind of risk, or they just avoid it altogether in emerging markets.
Yet the market reaction here was the exact opposite of avoidance. The briefing says it was 3.9 times oversubscribed.
Yeah, it generated a $1.36 billion order book for a $450 million bond.
So just to be clear, an oversubscribed bond means the demand to buy into this debt massively exceeded the actual supply.
Right.
There was a feeding frenzy. Investors were literally fighting for a slice of this pie.
They were.
And this is where the underlying mechanism is so crucial. A Tier 2 bond is risky, but almost $1.5 billion of capital rushed the door trying to get in. Why?
It points directly to the architecture of the deal.
Right, added a massive anchor investor, which changes everything.
Yes. FMO, the Dutch Entrepreneurial Development Bank, acted as a $50 million anchor investor.
So an anchor investor is the institution that commits a huge chunk of money before the bond even officially goes to the wider market, right?
Exactly. They act like the trendsetter at a party. Once the rest of the market sees a highly respected, stringent European development bank like FMO put down $50 million, the perceived risk just plummets.
Okay, let's unpack this. The AFC is the financial advisor orchestrating this whole thing. They are throwing around $100 million in tech VC to attract Western pensions, while simultaneously structuring a historic $500 million nature bond that triggers a $1 billion feeding frenzy.
It's a huge flex.
It's like a Hollywood actor suddenly starring in an indie drama and directing a massive summer blockbuster in the exact same week. It forces you to redefine who they are and what they are capable of.
Absolutely.
But are these two moves actually related? Or are we just seeing a coincidence of timing because the Africa Forward Summit and the Africa CEO Forum were happening at the same time?
Well, that is the hidden relationship the intelligence briefing says requires triangulation. You couldn't see this pattern by just reading one press release.
Right.
AFC Corporate reported the tech VC commitment separately from the Ecobank advisory role. Neither move alone proves a massive structural shift.
Together.
But together, triangulated within this single cycle, they show the AFC stepping into an institutional aggregator-style anchor position. They aren't just participating in the market anymore.
They're building the market.
Exactly. They are actively shaping the architecture of the deals. They are becoming the load-bearing pillar that holds up the entire structure.
Okay, so if the AFC is suddenly acting as this massive gravitational pull, drawing all this money into its orbit, whose orbit are they disrupting?
That's the key question.
Right, because if the AFC is taking up all the oxygen in the room, someone else has to be suffocating. And that brings us to the core conflict of this briefing. Someone's centrality is dropping fast.
Yeah. The briefing tracks a drastically reduced presence from BII. That's British International Investment, the UK's development finance institution.
Yeah.
Their centrality in these types of deals dropped from around 75% in Cycle 1 down to about 23% in Cycle 2.
Wow.
And in this current Cycle 3, their signal is barely registering. Their only major transactional activity noted is a participation in a facility for NMB Tanzania.
This brings us to the two lenses. The indeterminacy we talked about earlier, we have the exact same evidence. AFC's massive double roll rise and BII's sudden disappearance.
Right.
And intelligence analysts have two completely different ways to interpret this. Let's look at Reading A, which we can call the Great Shift.
So Reading A argues that actor centrality has fundamentally shifted across the continent.
Meaning, who is in charge has changed.
Yes. Historically, Western bilateral development finance institutions, like the UK's BII or the US Development Finance Corporation, they were the undisputed main characters.
They were the ones pulling the strings.
Exactly. They anchored the massive funds. They provided the stamp of legitimacy. Reading A posits that era is ending. There is an African MDB-led pivot happening.
MDB being Multilateral Development Bank.
Yes. Under this reading, the AFC is proving that being an institutional aggregator, the one who sets the terms and brings in the global capital, is no longer just a proprietary role for Western institutions.
The power has migrated south.
Precisely.
Here's where it gets really interesting. Because Rating B looks at the exact same drop in BII's activity and the exact same rise in AFC's activity and reaches a totally different conclusion.
Yes, Reading B is basically the cadence accident.
Think of BII like a massive pop star between album cycles.
That's a perfect analogy, because BII just published their sweeping 2026 to 2031 strategy in the previous cycle. Their next annual review isn't expected until September or October of 2026.
So of course they are quiet right now. They are just in the studio recording the next album.
Exactly.
Their quietness in the market isn't a sign that they've lost power. It's simply an artifact of the publication calendar.
Institutional finance moves very slowly. After launching a massive 5-year strategy, there is always a deployment lag while the internal teams figure out how to actually execute the new mandate.
Right. So in this view, AFC isn't displacing BII at all.
No.
AFC is simply an additional anchor entering the market alongside them. When BII comes back from their album break, there will just be two main characters instead of one.
And the briefing exercises strict neutrality here.
Yeah.
It explicitly states that this is a state of honest indeterminacy.
They don't take a side.
No. Both Reading A and Reading B are sustained at a moderate strength. The analyst is warned that within this specific 2-week cycle, there is simply no way to declare a winner. Both readings perfectly explain the evidence on the table.
They refuse to tip the scales just for the sake of having an answer, which is frustrating but very disciplined.
Very.
But let's pull on the thread of Reading B. If Reading B is true and the AFC is just an addition to the ecosystem rather than a replacement,
Right.
Who else is joining the party?
Right.
Because the briefing spends a lot of time on something it calls actor class breadth. It isn't just the AFC making moves here.
No, the ecosystem is widening significantly. The briefing details 4 distinct actor class adaptations co-occurring in this cycle. We already covered the African MDB class, which is the AFC playing its double role.
What are the others?
Well, beyond that, there's a continental MDB framework evolving. The African Development Bank, the AFDB, is pushing their NAFAD framework, which is backed by ADD acting as a continental first loss guarantee anchor.
Okay, let's pause on the concept of a first loss guarantee, because it is a brilliant mechanism for manipulating market psychology. How does it actually work in practice?
So think of a first loss guarantee, like a highly confident friend offering to pay for dinner if you end up hating a new experimental restaurant.
Oh, I like that.
You were hesitant to go, but now your risk is gone, so you agree to try it. In finance, if a pool of investments goes bad, the entity providing the first loss guarantee takes the initial financial hit up to a certain percentage.
So it completely de-risks the environment for other, more cautious investors.
Exactly, because they know a buffer exists before their own money is threatened. Entity stepping up to provide this on a continental scale makes massive infrastructure and development deals significantly more palatable to private capital.
That is huge. Okay, so that covers the MDBs. Who else is adapting?
There is strong bilateral DFI continuity. This goes back to FMO, the Dutch bank, recurring as a $50 million anchor at the Ecobank bond.
They're still playing their part.
Yeah, they aren't fading away. They are repeating the exact role they played in 2021 with an earlier Tier 2 bond. And finally, and perhaps most surprisingly, there's the rise of corporate institutional actors stepping into the anchor role.
Corporate actors, like who?
Energy majors. Equinor, Shell, and Total Energies are acting alongside LGT as non-DFI anchors for the $500 million close of the Lightrock Accelerate 7 fund.
Wow. Oil and gas majors stepping in to anchor a tech VC fund?
Yeah.
They are clearly looking to diversify their own portfolios into the transition economy, buying their way into the future of energy. This paints a picture of a very crowded room.
It does.
And this actually brings me to caveat 4 in the briefing. I want to push back a little. I want to challenge the core premise that the AFC's moves are the definitive signal of the power shift.
Okay, let's hear it.
The briefing itself admits that calling the AFC's double role the load-bearing observation is highly contestable. Couldn't an analyst argue that the real story here isn't the AFC at all?
You mean something else is driving this?
Yeah. What if the real story is that a highly complex instrument, like a $450 million nature bond, actually exists in the African market, and that a Western DFI like FMO is willing to anchor it again? Aren't we maybe just obsessing over the AFC because they made the biggest splash this month?
That is a very fair point. And the intelligence discipline requires actively confronting that exact fragility. The briefing calls it a vulnerability to coordination inference.
Coordination inference.
Yeah. This is the psychological trap of assuming that just because events happen near each other, they are part of a coordinated overarching pattern.
Oh.
Like we said, the Africa CEO Forum and the Africa Forward Summit happened within 4 days of each other.
Right.
It is entirely possible that all these different actors, the AFC, the AFDB, FMO, the energy majors, are just announcing their separate, completely unrelated projects at the same time because everyone is at the same conferences looking for PR coverage.
So if a second nature bond is issued next year and the AFC has nothing to do with it, then the instrument itself was the real breakthrough, not the AFC's positioning.
Exactly. The analyst must actively resist connecting dots that are merely sharing a calendar page.
Okay, so if we can't solve this today, and the briefing flat out refuses to pick a side between Reading A and Reading B, how do we eventually find out who is right? Because nobody likes a mystery without an ending. How does an intelligence analyst close the file?
This is where the methodology really shines. The briefing relies on a falsifiability matrix.
A falsifiability matrix.
Yes. It sets a rigorous standard, stating that discrimination is downstream at 12 to 19 months.
Meaning we won't know for a year or more.
Right. We can't solve the indeterminacy now, so we have to define exactly what future observables will prove or disprove our theories.
That makes sense.
Institutional finance moves incredibly slowly. You can't measure the impact of a billion-dollar shift next Tuesday. So they list 8 specific observables, but 3 are the critical tripwire.
What are the specific metrics we are waiting for?
Observable 7, or O7, looks at the 12 to 18-month horizon. It asks as a structural question. Will a second African MDB, such as the AFDB or Africa 50, pivot into this exact same kind of institutional aggregator anchor role by the second half of 2027?
And if they do?
If the answer is yes, Rating A gets a massive boost. It proves the AFC isn't just an anomaly, but the vanguard of a whole new class of African institutions taking charge of the continent's financial architecture.
Okay, then we have Observable 8, which checks in on our missing pop star.
Yes. O8 looks at BII's deployment data for the 2027 financial year. The question is simple. Does BII recover their central framing?
Do they make a comeback?
Right. When the data comes out, do they come back from their strategic planning phase and start dominating the deal flow again? Or does their influence stay reduced in the hard data?
And if they stay reduced.
Then the cadence accident theory of Reading B falls apart completely, and the displacement theory takes over.
Okay. And the final key metric is observable 6, which I think asks the most brutally pragmatic question in all of finance.
Did the money actually show up?
Yeah.
Yes. The AFC claimed their $100 million tech VC commitment would act as catalytic capital to mobilize $300 to $500 million from Western LPs.
Right.
'06 requires the analyst to check the final fund closures between Q1 and Q3 of 2027 to see if they actually hit that target. Or, as the briefing dryly notes, was it just allocators' self-reported PR?
Ouch.
Yeah. Because if the Western pensions don't actually put their money on the table, the AFC's power play was basically an illusion.
So what does this all mean for you, listening right now? You can lift this exact framework and use it in your own life.
Absolutely.
When you are sitting in a meeting and two factions are presenting conflicting narratives using the exact same data, don't force a verdict just to have a neat and tidy answer.
Embrace the indeterminacy.
Yes. Write down what specific future data points will undeniably prove one side right, and then set a calendar alert for 6 or 12 months down the road.
It's so effective.
It is the shortcut to being genuinely well-informed. You stop arguing about who is right today, and you start looking for the tripwires that will reveal the truth tomorrow.
It completely changes how you consume complex information. It shifts you from a reactive consumer to a strategic observer.
To wrap up the core journey we've been on today, we explored the mechanics of a massive $450 million Tier 2 nature bond and a $100 million tech VC LP commitment.
We covered a lot of ground.
We did. We examined the shifting tectonic plates between traditional Western DFIs, like the UK's BII, and rising African MDBs, like the AFC.
Yeah.
And we saw how true analysts weigh Reading A, a fundamental displacement of power against Reading B, a simple calendar coincidence of addition without tipping the scales.
But before we sign off, there's one final thought to mull over.
Huh.
Yeah. Buried deep in the briefing is a mention of Probe 1.4, which is a refined look at African pension funds and sovereign wealth funds acting as sole anchors. They highlight RSSB, the Rwanda Social Security Board. Think about the broader implications of that mechanism. If African pension funds are keeping their own capital on the continent and African MDBs are structuring the deals.
Then they no longer need to be paired with Western development finance to legitimize a fund.
Exactly. The reliance on external validation vanishes. If Western institutions are no longer the necessary gatekeepers of trust, how will they have to adapt their own strategies just to stay relevant in the markets they used to completely dominate?
Wow. The puzzle pieces don't just make a new picture. It's an entirely new puzzle.
It really is.
Thank you so much for joining us on this deep dive. Keep looking for the hidden architecture behind the headlines. And remember, the next time you see a perfect set of footprints at the crime scene, ask yourself if they might just belong to a pop star between albums. We'll catch you next time.